Good morning. Welcome to September. I'd like to say welcome to spring, but unfortunately the National Command Council has banned spring until level 1. So we'll just have to wait for that. Hopefully not too long. August was a decent month for markets. Low volumes as usual with the US and Europe on summer holidays, but some decent gains across the various asset classes. Today we'll be going through the usual market update and economics review, and then ending off with portfolio construction and how to position yourself for the low return environment that we're currently experiencing and expect to continue experiencing for another decade at least. But starting off with performance, just to show you that the funds are working well in the current environment and that they have been positioned correctly. You can see there across the range, low, medium and high risk, and across the time frames, 1 year out to 10 years, the funds all doing very well in their respective categories. First, and that's not first quartile, that's number 1. Those funds are number 1. So we're very proud of that performance and very happy to see that the funds are working as planned. Looking into the Signature 70 portfolio against the various multi-manager peers, you can see they're doing very nicely over all time frames. First, across 1, 3, 7 and 10 years. Still quite a lot of dispersion across the 1 year period, with the Signature 70 fund up 8.5% compared to the bottom multi-managed fund, they're down -2. A lot of dispersion for multi-managers. We wouldn't expect so much dispersion. Out to 10 years, you can see there much closer returns from the various funds. Performance also good across single managers, comparing Sygnia against the single managers, only behind Ford over 1 year, Standard over 3 years, and ahead on 7 and the 10-year time frame. So the funds are performing as expected in the current environment, and we're very happy with that. And I'll go into detail onto the positioning at the end of the webinar. But it's all still about the global pandemic. Despite that, the MSCI All Country World Index, which is the barometer for all equity indices and markets across the world, reached record new highs in August. Quite phenomenal, as if the COVID-19 and lockdown pandemic never happened. PMIs helped push markets to new highs as they surprised the upside. The chart on the bottom left there shows PMIs across various countries, the US in white, China in blue, Europe in purple, global in orange. Only Japan is still below the 50 level, with the rest of the countries nicely in expansion. The Google Mobility Index on the bottom right is showing that we have plateaued for the last 2 months. We seem to have found the new normal. The orange there is China, which is close to old normal, sitting around the 90 level, whereas the rest of the world, emerging markets and advanced economies in the white and blue, around 70. Just showing that the world is back to working, but in a different sort of way. With a lot of people working from home, a lot of shopping being done online. And we don't expect that to change until there's a vaccine that's out and the fear disappears from the world around COVID-19. And even then, some of what the changes we have seen will become structural. And we may never go back to the old normal as it was. But fortunately, markets are no longer concerned about the virus. So that we did have second waves that were quite aggressive in France and Spain, but they didn't lead to high hospitalization usage, and they certainly have not led to an increase in deaths. So that plus positive news from even more pharmaceutical companies about vaccine developments allowed markets to reach new highs. So generally very positive news, markets focusing on strong PMIs, strong support, and not too concerned about the hotspots, which we believe is the right thing to do, as they're not going to lead to further lockdowns. But I did mention that we are seeing divergence as a result the new normal, with lockdown winners doing particularly well. The top blue line here is the NASDAQ, which you can see is up 64% from the start of the year, compared to the South African financial index, which is our banks and our property stocks and our insurance companies, the green here at the bottom. And you can see there absolutely no bounce at all. We fell to lows in March, and there's been no recovery. So a huge divergence between the lockdown winners, particularly emerging market banks, property stocks, insurers, and lockdown winners, the tech companies and healthcare companies. Second here is gold and the MSCI World. So whether you're in global equities or gold, you're doing as well, and both benefiting this year from renewed optimism in the new normal. Looking specifically at the US, it was Biden's month in August, and he appointed his running mate, Kamala Harris. Despite that, and although he's still leading against Trump in the elections, the gap did narrow slightly on the appointment of Kamala Harris. But it's all about the dollar in the US, and the top chart here on the right shows just how weak the dollar has been over the last month or so. In fact, August saw the dollar have its weakest month since 2005. And we're now sitting at 2-year lows for the dollar as a result of growth in the rest of the world improving, and the US COVID-19 cases continue to rise, and the probability of a Democrat victory still remaining high. So it all boils down to what's going to happen in the polls on the 3rd of November. At the moment, if you look at the bottom right chart there, the blue being Democrats, dark blue is Democrats, light blue is leaning towards most likely Democrats. The red is the Republican states, with the pink being leaning towards and most likely voting for Republican, whereas the gray states are the swing states, or the toss-up states, as it's called in this chart. But the September polls show that even if Biden loses the toss-up or the swing states, he's still likely to win the Electoral College, and despite the gap having narrowed between Trump and Biden. So at the moment, it looks like Biden's got in the bag when it comes to the 3rd of November, which means that Trump's going to do whatever he can, and he's going to continue to create volatility to make sure that he does win those elections. So there's been a scandal about the US Postal Service, where he's one of his very big donors and supporters is trying to slow down the delivery of post and preventing people from voting through the postal system, which apparently hurts Democrats more than Republicans and is leading to a lot of concern. There's also concern he's going to try and delay the election altogether, and that actually is in the betting odds. That's actually got quite a substantial possibility and probability now that the election is delayed. More importantly for markets is the fact that we're seeing an escalation in the US-China tech Cold War. We think this is going to be a sustained war over the next couple of years, if not long term. As China tries to reach tech dominance, the US tries to defend its position. We saw last month that the US banned TikTok and WeChat. This month, in retaliation, China has forced ByteDance to get permission to sell its operations. So there's a chance that TikTok or Microsoft may not be able to buy TikTok, the US TikTok operations. China hasn't released that yet. So we have to wait and see, but certainly expecting a lot more volatility around this arena as there's increased focus on security as an excuse for Trump to get involved in China. They're also planning to prevent not only US pension funds, but now endowment funds from investing in Chinese stocks listed in the US. And we think there's going to be a lot more that's going to happen along this front, leading to additional volatility. But for the moment, a weak dollar is positive for the rest of the world. Most of the emerging markets fund their debt in dollars, so a weak dollar does lead to cheaper funding rates, cheaper interest rates, cheaper debt for emerging markets. So that's a positive, despite the volatility. We also had some positive news on the fiscal and monetary support. The Fed adopted a new policy framework about targeting average inflation. So this has been discussed for the last 2 years, but Powell at the recent Jackson Hole Symposium in August announced it as an official framework. So you can see on the chart on the bottom left here, the US inflation is sitting at about 0.75%. It's the white line, with the US interest rates at 0, that's the blue line. And the dotted line here in this band is the average inflation targeting. Not only that, but what did surprise markets and was additionally dovish is that the monetary policy framework is also going to target employment, and particularly minority employment, with the Fed acknowledging that minority employment are the first to lose their jobs and the last to gain their jobs. And as a result, we're likely to see an inflation overshoot when inflation eventually does return. And that's probably going to lead to a weaker dollar over time, which again is very positive for markets, positive for emerging markets in particular. Fiscal support remains strong on the right-hand side, but obviously it's leading to a lot more debt, which is a problem I've mentioned in the past, and is why we will see a low return environment over the next decade as we try and pay down some of that debt. South Africa, you always have to start the slide with a big sigh, unfortunately. Prescribed assets, there's a lot more concern that has reared its head. Nothing official, but people are concerned about prescribed assets because the ANC has announced that they are looking at proposals to change Regulation 28. And any changes are always met with concern. So the good news is that South Africa did open its economy up to level 2, which is fantastic. Still can't travel internationally, but otherwise mostly open and back to normal. A little bit too late, unfortunately, and we already have a huge amount of debt, as Tito announced with our special adjustment budget. We have taken on some loans from the IMF and the New Development Bank to try and achieve that meet those debt requirements. But interestingly enough, SA rejected the World Bank $2 billion facility in August because of the conditions around that loan. So I'm not too sure where we're going to find that funding from. Alternatively, it might have to happen in the local market, or maybe they'll negotiate the terms differently. But as I said, starting with the top right-hand chart here shows GDP per capita growth. The GDP per capita is your best view of living standards. It's GDP per person. The higher that goes, the faster it grows, the better the average person's living standards are. So the more microwaves you can own, or holidays you can take, or restaurants you can go to. This chart is the last 2 decades. You can see that the first decade we pretty much tracked the median country, and over the last 10 years fell rapidly behind the median country, that gap widening to all-time lows in 2019. And you can understand why, with the continuation happening. Over the last 4 months, we've lost out 10 billion rand in taxes from lack of alcohol and tobacco being sold over that period. It doesn't mean people weren't buying tobacco and alcohol. It just means that tax revenue wasn't being generated. ICASA has delayed the new spectrum until 2021, another disappointment. International borders to remain closed to tourists, probably also until 2021, and stage 4 load shedding has hit us all very hard. And for these reasons and many others, markets remain incredibly skeptical that South Africa can achieve the reforms it needs to return to job growth and to get our country back on a higher growth trajectory. And what are markets saying? If you look at the bond market, we've got the steepest yield curve in history. So it's the back end of the curve relative to the short end. We've also got SA domestic stocks priced at a significant discount. And this is the bottom right-hand chart here from Investec. This only looks at South African listed stocks on the JSE, but if the red line shows the globally focused stocks, so British American Tobacco, the Richmonts, the Naspers, up 21% year to date. And then you look at our local focused stocks, our industrials, our banks, our property stocks, down 30%. So a 50% gap that has emerged because of a lack of confidence in South Africa, and easy to understand why people feel that way. There is some good news. We haven't got a catalyst yet to turn positive on South Africa, but there is some good news. In terms of trade is looking very positive, with the prices of gold and platinum rising relative to the price, our imported price of oil. We're also seeing positive news on the infrastructure plan. So South Africa has underspent 30 billion Rand per year over the last 5 years, despite our debt to GDP skyrocketing. So we've clearly been spending money on the wrong things. We haven't been spending it on investing. We've been spending it on consumption, like wages. And that's part of the reason why Tito is trying to achieve 230 billion Rand cut on expenditure, particularly wages, at the medium-term budget policy statement in October. Markets are very skeptical we can achieve it, but we need to achieve it so we can start spending money on important things like investment and growth. Anyway, we've been underspending by 30 billion Rand per year over the last 5 years. So Dr. Makopa, the head of investment and infrastructure, the presidency, announced 340 billion Rand infrastructure plan covering 62 projects. And these projects are all decent projects. They're all projects this country needs. It came from a pipeline of 276 projects worth 2 trillion Rand in water, energy, transport, and IT. All projects that will lead to enhanced growth, that'll make it easier for business to happen, easier to transport your goods, cheaper energy, and better IT infrastructure, things we need. So the pipeline is looking good. And what's even more promising is that if we look back at the independent power projects that we had a couple of years ago on the green power, it was done in a very haphazard manner. Some investors made huge fortunes, others lost money on infrastructure projects which shouldn't happen. But now the government has listened, and it looks like the plan is to put all these projects through the Development Bank of South Africa, DBSA. They will centralize, they will package the projects, they will provide enhanced transparency and governance. And if we can get this right, it'll create a lot of investor confidence into the pipeline. Unfortunately, the government doesn't have the money to do this. They don't have 340 billion Rand. So they're relying on pension funds to support this investment, which is fine, provided that there's a decent return and it's done in a way that is transparent, and we can make sure that corruption is minimized. Then I think there'll be a lot of willing investors. So the government is looking to the 4.5 trillion Rand retirement fund industry, and for that reason, the ANC has proposed changes to Regulation 28, and we should see a draft proposal document after the next 2 weeks. So it's anybody's guess to what that's going to do, but a lot of people have submitted their proposals, and the most likely one is that currently private equity is limited to 10% in pension funds, but it shares a 15% limit with hedge funds. So we're likely to see that a separation of those two, so that private equity can go to 10% without having to worry about the hedge fund limit, or maybe that even they will expand that limit. What is concerning to me, though, is why there's this focus on private equity. To me, an infrastructure project like a toll road or a water utility is not something that you want equity exposure to. It's something with a very consistent and low risk revenue profile and expense profile, and as a result, it's probably best to fund it with bonds, which is a cheaper way to do it. So I'm not too sure why we're looking to expand the private equity limits when bonds are an easier way, and you don't need any changes to Regulation 28 to invest in bonds. The one concern or the challenge on the bond side is just our yield curve. The yield curve is the steepest it's been in history. You're getting inflation plus 6%, risk-free from investing in South African bonds. So why would you even worry about the stress and the fees and the expense and the risk of investing in anything else if you can get government bonds at inflation +6. So until we see the yield curve start to normalize and come and flatten a bit, I think there's going to be there could be some funding constraints for this, unless the returns are really exciting. But if they're that exciting, then it makes the projects very expensive. If the projects are very expensive, it means toll roads are going to have very high tolls to get through them, or our water prices are going to go up, or our electricity prices are going to go up. There's no free lunch. Somebody has to pay the bill at some point. The reason our bond yields, the bond curves are so steep is an anomaly, and it's why we are overweight bonds, and I'll get to that on our positioning slide later. So looking at investment allocations, I've spoken about Japanification before, so I'm not going to go into much detail, but just to say that Japan was the roadmap that we followed for a low return, low growth environment, and it seems to be working pretty well. The next strategic shift, which we think is going to happen, which we haven't positioned for from a strategic perspective, but we are watching quite closely, is a shift of growth from the West, the US, to the East. It's a theme that's been in play for a while, but it's a theme that's going to take some time to get there. The bottom right-hand chart shows the World Bank and IMF data, which predicts that by 2024, 4 of the top 5 global economies, the biggest 4 of the top 5 global economies, will be in the East: China, India, Japan, and Indonesia. There are a number of reasons that we can see that this is going to accelerate. That the US is going to lose its share of growth. It's going to lose its share of foreign currency reserves. Both China and Europe are trying very hard to make sure the renminbi and the euro take over from the dollar. In addition, China's doing a lot of work to improve its economic freedom. It's improved rapidly as it opens up its bond, its currency and money markets. At the same time, the developed world in the US and Europe, that we've actually seen a drop in economic freedom as there's this commingling between government and private sector as we rely more and more on fiscal support, which means the government's got to spend more money, the government's got to get more and more involved. That's what we're seeing here in South Africa. The more you rely on your governments to bail out of holes, the more the government's involved in terms of spending, the more those lines, the higher taxes go, and you get a very much a private sector being pushed out of the market and a lowering of your economic freedom. So it bodes well for or at least a narrowing of the gap between China and the rest of the world from an economic freedom perspective. I've also spoken about the lower oil environment, which is bad for the US as a whole, and may see growth shift more aggressively out of the US. And it's something that we're keeping a close eye on. We have applied to launch an emerging market ETF. That'll be the Sygnia ITRIX EM50 ETF, and we think that longer term this should be a good addition to many portfolios to diversify. And the US makes up 66% of the MSCI World Index, compared to China, which is far lower, below 10%. And we think that markets should adjust to that over time. So a brief slide on our positioning and how we have positioned for the low return environment. This is a quick introduction. We've got on the 14th of September, there's a fund product webinar that will specifically talk about each of our superhero funds, as we're calling them, our 7 funds, which are great investments for a low return environment. So if you haven't received the invitation for Monday, the 14th of September, please send us an email and we'll get back to you and make sure that you register for that. But as a whole, when you want to invest in a low return environment, the most important thing is to keep fees low. Rule number 1, control what you can. Fees you can control, make sure that you can control your fees and get them as low as possible. So the best way to do that is a large passive call. So you can have passive allocation to equities and bonds and cash that provides, and it's global and local, that provides low cost, liquefied, diversified exposure to various markets. Then once you've got that as the basis of your portfolio, you need to look at alternative satellites that can provide some sort of growth in a low return environment. Yes, higher risk, but higher return. And depending on your risk appetite, you can put more of these on or less. Some investors may choose to have none. Some might have quite a lot and even have the satellites overweighting compared to the passive core. Some of the traditional asset classes that people like to have to protect against a downturn in markets are gold and developed market bonds. And I have spoken about that in the past, and we firmly believe that quantitative easing has distorted those asset classes to the point where you now have to pay in. There's a negative yield if you want to buy developed market bonds in Germany and parts of the yield curve in Japan. And the US is giving you nearly zero yields. Gold has, as a result, has risen dramatically. And we just don't think those are as good a cushion as they used to be. The Rand is still your best cushion. It's great to have money offshore. It's a shock absorber. And whenever there's a risk-off environment, the Rand weakens dramatically and protects your capital from a Rand perspective. So you need to take your money offshore, and then you need to find places to put it. You don't want to, well, we don't want to put it in gold or developed market bonds. So you do put a passive core into MSCI world equities, for example. But then you need to look at uncorrelated asset classes. So the five that we have, one is real estate. So we've got the Sygnia property ETF, which has got no exposure to hotels, very low allocation to the sectors that have been hurt hard by the new normal, with high allocations to the industrial sector and specialist sectors. So we think that's quite defensive, and we have got an allocation to that. The second building block here is tech, and that is companies that are going to grow their market share, even in a slowing revenue environment, because they grow their revenue by growing market share. So it's new products that steal market share from existing ones, as people move from brick and mortar to the online spending. But also in the fourth industrial, there's new products. It's innovative wearables or 3D printing or space or whatever it may be. It's new spend. The third satellite here is emerging markets, which I spoke about in the last slide, particularly emerging markets, Asia ex-Japan. And that is just really benefiting from the huge middle class that those countries see. And as that middle class moves and grows, gains internet exposure, moves towards cities, and as a result moves up the living standard curve and spends more money. And that will drive growth in those countries, even as the world as a whole slows. The fourth is healthcare, particularly ESG and impact investing. Healthcare benefits from the aging populations that we see around the world, particularly developed markets, Japan, Europe, China to some extent, and the US. We're going to see increased spend on healthcare, and that's partly driven by aging populations, also partly driven by new technologies and new products, new vaccines, new medical procedures. We're constantly pushing the boundaries on the medical frontier, and whatever we can do to slow the aging process, to improve the health standards of people, to research for COVID-19, people are going to spend in those sectors on a structurally growth vector going forward. And the last one is unlisted credit and infrastructure. So I spoke about infrastructure in South Africa. We certainly are watching that space very closely. We have been interacting with many of the banks. There's a lot of talk about social bonds, particularly around COVID-19, but also around the water, energy, IT, infrastructure space, and some very clever structures around that. So looking at ways with enhanced governance, where you'll invest in a social bond at a certain rate, might be slightly cheap compared to government bonds, but if that project fails to meet certain deadlines, or there's a concern about governance, the coupon they pay ratchets up very quickly, or they call on guarantees from the government. So a lot of clever ideas in that space to help the infrastructure space, to help the environmental space, the social space, but also particularly around governance. And unlisted credit, it's a nice fifth wheel to the portfolio. It's not correlated directly to equities, not correlated directly to bonds. Your credit spreads are more based on the credit worthiness of various companies, and nice diversified to portfolios. So these are 5 satellites that we put that are all uncorrelated alternative sources of growth in a low return environment, and you can allocate various amounts to each depending on your risk return profile. And we have all 5 of those in our skeleton balanced range, which is this portfolio pretty much. Our signature range also includes some active traditional long-only bonds and some active traditional long-only equities, which is more of a barbell approach than a core satellite approach. Looking more short-term risk management, what's driving our short-term Tier A decisions. Generally speaking, the most important driver is liquidity, and that's looking very positive, even more positive now that the Fed has adopted a inflation targeting, average inflation targeting environment. Fiscal support remains strong. We're not at all concerned about stringent lockdowns coming through in the second wave. Even the second waves that happened in Spain and France recently, it didn't lead to any additional use of hospitals. In fact, including South Africa, the hospitalization rates that were modeled, we're sitting at 20 to 25%, about a fifth to a quarter of what was expected to be used. Unfortunately, we spent a lot of money in South Africa and probably other countries where we've entered into long-term leases and we've created hospitals, and they've never seen any usage because there's just no demand. So that's, that goes to the point of the huge misunderstanding to what COVID-19 actually is. A huge lack of consensus as to whether lockdowns even worked. But the whole point of lockdowns, even if they did work, was to remove the stress off hospitals. We haven't seen the stress on hospitals. So we are not concerned about that. We are concerned about tech being stretched. The big 6 US tech stocks, the top right-hand chart that I showed before, shows that their weight in the S&P 500 is bigger than in Y2K. Not only that, but those same tech stocks, their market cap is bigger than the entire European stock market. If you look at Amazon and Apple alone, their market cap is bigger than the entire FTSE 100, the UK stock market. Elon Musk has gone from being bankrupt nearly a year ago and facing all sorts of litigation to being the 3rd richest person in the world. Well, that was 3 days ago. Over the last 2 days, Tesla's lost 20% of its market cap. So we have to worry about the tech stock position, particularly when we saw 20% rallies in Tesla and Apple after the stock splits. That's like going to the bank with a 100 Rand note saying, I'd like 5 20s. And the bank saying, here, sure, you can have 6 20s. You just get an extra 20 Rand note just for fun. When market starts to price like that, you have to wonder about how efficient they are and how much euphoria is driving tech. So we have reduced our FANG exposure. We're preferring our fourth industrial revolution to still get tech exposure, but the smaller companies are not looking as stretched as the larger tech companies. We've also moved more into healthcare sector with our Health Innovation Fund, which is as well, it's not looking as stretched as tech. Looking locally, we remain underweight SA equities, quite a large underweight. There's a lot of value there. And as you saw, one of the opening slides, our financials have not bounced at all. There's been no recovery in that. And when we do get back to a vaccine or a move towards some sort of blend of the new normal and the old normal, there has to be a bounce in that sector. But there's no catalyst yet. Until there is a catalyst, we remain underweight that sector. We remain overweight global. As I said, it's a best shock absorber. It's a good diversifier, but with protection. I mean, the Rand is looking very weak. The Rand is 2 standard deviations away from its trend. It's weak like our banks are. It's a lockdown loser. When we come back to some sort of blend of new normal, old normal, the Rand will strengthen just because of the fact that we're moving into a trade surplus. Our exports are looking really strong not because of volumes, not because of anything we're doing, but because of the price of gold, the price of platinum, the price of iron ore, the price of copper even, all looking really strong. So even though we've got own goals and we've shut down tourism and other things, fortunately the commodity prices in terms of trade will mean that at some point our Rand will get stronger. And for that, we want to be protected against Rand strength, and we do have our zero cost protection. As I've mentioned before, given QE distortions, we're avoiding global bonds and gold and prefer our 5 superhero satellites. And then looking locally with the 325 basis points cut in interest rates, we've reduced cash to as low as we can go. We've reduced income to underweight position, and we've gone overweight SA bonds. So when you get an additional 5% by being overweight bonds compared to cash, when the yield curve is the steepest it's been in history, the risk return payoff just looks attractive. And the bottom right hand chart there shows how our bond, and I've shown this chart before, but how our bond yields are giving the highest return in the universe. You can either earn 0 in Japan, negative in Germany, 0.5% or 0.25% in the US, or you can earn 6% in rands, currency hedged. And that is a risk-free rate. The only way that and if you look at that, the decomposition of that, you're looking at about a 6% for inflation differentials and for credit, and then there's a 4% default risk priced. But those bonds are issued in rands by South African government who have a printing press. I don't understand why there can be a default risk priced into that. Yes, you have volatility, and maybe it's a proxy for volatility, and there are some nuances, but generally, when a government has a printing press, it's very difficult for them to default. So I think that that yield curve needs to come down at some point. Again, it's a lockdown loser. We are printing huge amounts of money at the moment in terms of trying to catch up with our COVID spending. When that normalizes, possibly at the medium-term budget policy statement, if we can cut expenditure, there should be a strong rally in our bonds. But for now, even if there's volatility, those yields go from 10 to 11 and back to 9 and then to 10. Over a year, you're earning 10% compared to 3% or 4% in cash. So we think it's worth it, particularly with the positives around externalities in terms of trade. Also, a bumper, a record maize crop this year, 40% bigger than last year. Again, not something that we can take credit for as a country, but when the rains are right and the weather's right, and you have 40% more maize, you can export that. It's got to be good for our economy. So fortunately, some external wins against some internal own goals, but there are some reasons to be positive and to at least be overweight our bonds if we are underweight our equities. It is a structural move for South Africans over the last couple of years, with very stringent monetary policy regime where we're trying to kill inflation and move inflation from the 6% target to the 4.5% target with a very hawkish central bank, which they have achieved that. It meant that we had very high real yields. At some point, your cash in the bank was giving you 2.5% above inflation. That doesn't exist anymore. Inflation expectations have been broken. South Africans have been broken, and now, if your money's in the bank, you're lucky if you get inflation. We may see another rate cut, which will mean we're going to get below inflation. So people have had to adjust. You need to move some of your money out of the bank into bonds. Still government guaranteed. Yes, there's volatility, but over a 10-year period, you're likely to get your money, the yield that you've put in, which is a positive. Globally, people aren't as lucky. If you're in Europe or the US or Japan, you don't have that luxury. You've been pushed out of cash into bonds. Bonds are giving you zero. You've been forced to buy property, or you've been forced to buy equities. So we haven't had that yet. But again, part of the catalyst we're seeing for SA equities, when the yield curve does normalize, when bond returns start to come closer to cash, when they drop towards a more normalized level, investors again are going to be forced out of bonds locally into South African equities. So we've got a huge amount of cash that was sitting on the sidelines, that was sitting in cash, moved into bonds, and that cash at some point will move into SA equities and will buoy our markets, and we'll catch up to other emerging markets. But not yet. We're waiting for a catalyst. Locally, it might be the medium-term budget policy statements. Globally, it might be a vaccine, but there's no catalyst yet. So we remain comfortable being overweight bonds and watching the space to see what happens. And that is a wrap from the portfolio. Let me look into some of the Q&A and see some of the questions that are coming through. Okay, so there's a question on, I've just mentioned in terms of shifting out of SA bonds into SA equities should a catalyst emerge. So, markets tend to move in cycles. They tend to overshoot on the top side and the bottom side. Certainly, SA bonds have overshot on the weak side, and that's why they're providing a lot of value. Normally, so bonds are giving you about roughly inflation plus 6. Normally, bonds should give you roughly around inflation plus 3. So, when we start to see bonds move down to that level, that will give you a very nice return, because you'll be earning your 9% yield or 10% yield, plus you'll get some capital gain as that yield curve flattens. Then once we get to lower return expectations of about inflation plus 3, maybe 3.5, then you could look to move either back into cash if you are low risk, or if we're seeing some positive catalysts on the South African economy in terms of infrastructure projects leading to growth, employment growing, a lot less red tape. I mean, it's just, it's so simple. ICASA needs to cut the red tape and open up a spectrum, so we can lower the cost of telecommunications. That's, Cyril's had that for 3 years as an easy win, and it is an easy win. And we need to open up our borders to tourism, get the foreigners to come back to the country and spend the money. It's an easy win, and we shot ourselves in the foot a while ago because of the visas. We're finally sorting out the visa issue, and now we've closed our borders. So that's the IT spectrum, the tourism, load shedding. Again, remove the red tape. Move the limit in terms of self-generation from 1 megawatt to 10 megawatts. You can solve the energy crisis overnight. All we need to do is remove red tape, and it shouldn't be a difficult process. We also need to remove corruption, and fortunately, Cyril over the last week seems to be pushing very hard, and hopefully we'll see cabinet reshuffle, and hopefully we'll see some hard lines being taken on corruption. But bottom line is, without confidence, no one will invest in South Africa, or at least not South African equities. You need investor confidence, and to get confidence, you need structural reforms. You need to stop corruption. So back to the question. Yes, South African bonds, decent yield, potential capital gains, despite there is a lot of volatility that could happen in the short term. When yields get down to maybe inflation plus 3.5, either look at moving into cash if we haven't seen positive news in South Africa, or South African equities if you have. In terms of US tech, the question is, explain stretched. Stretched is a difficult thing to define. You cannot call market tops, you cannot call market bottoms. it is the easiest way to lose money. So the way we manage that is we take very small incremental positions as we move up and down at various levels. But what we've been doing is slowly moving tech as it keeps running. We keep selling it. What we're doing is we're looking at investor positioning. So if you want to look at the amount of money that's in ETFs, so tech ETFs, relative to sort of maybe the MSCI value ETF, that is looking at all-time highs. If you want to look at PEs or PEG ratios, I mean, Amazon's sitting at 160 PE. That's also looking close to all-time highs. So the number of indicators which make US tech look expensive. I mentioned Tesla before. Tesla's market cap is bigger than the next two biggest car companies combined, Volkswagen and Toyota. Volkswagen and Toyota produce 15 million cars a year. Tesla makes 340,000 cars a year. But Tesla's market cap is bigger than that. So there's certain things that are just looking stretched, expensive. But again, as I've mentioned, it's very important to take these things in small tranches, because you cannot, markets can stay irrational longer than you can stay liquid. We're well aware of that, and that's how we do take things in steps. But for the moment, I think it'd be easy to look back in 3 years' time and go, oh, tech was stretched. When tech can fall, or Tesla can fall 20% in 2 days, the Nasdaq can fall 10% in 2 days. When that volatility reaches those really extreme levels, you need to worry why that volatility is so high. And it normally means that we're trading on very thin volumes, which we have been over August, and you're reaching levels that aren't fundamentally driven by a much stronger volume base. So a very good question, which I unfortunately have an excellent answer for. Question about South Africa being the next Venezuela or Zimbabwe. So South Africa has got incredibly strong financial markets. It's got incredibly strong institutions. So while we do score some own goals, I can't see us ever reaching the level of Venezuela or Zimbabwe. Certainly Argentina or Brazil or Russia, I think those are much closer peers. Turkey. But if you look at what Turkey's achieved, Turkey's living standards have doubled over the last decade. Doubled. Ours have moved sideways. Argentina, which has defaulted on its government dollar debt. So again, it's very easy to default on dollar debt because you don't have a dollar printing press. They've defaulted 9 times on their debt. Their living standards, their GDP per capita is higher than ours. So it seems like we are coming off a very low base. And there's room for us to have some easy wins. But I think our financial institutions, our legal institutions, will protect us from moving into a Venezuela / Zimbabwe environment. Good question. That is, I suppose, that is a risk. Again, you can protect that by hedging the currency, and that's why still on a currency hedge basis, when foreigners are earning 6%, then there's limited risk to that position. What bond would you recommend instead of cash in terms of holding? Sygnia have got 2 unit trusts that one is a bond tracker, the other is an enhanced bond fund. Both are very low cost, so if they're 40 basis points, including that. The one just tracks the All-B completely, the All Bond Index. The other gives you the All Bond Index with no duration risk, but a little bit of credit upside, mostly government guaranteed credit. And the one's yielding, I think, 9.7, and the other one's yielding 10.3%. But the webinar that's coming up on the 14th of September is going to go into a lot more detail on those funds. So tune in for that. I think that's a very exciting place to invest. Whether you put 10% of your cash or 50% of your cash is up to you. But with cash generating 3.5%, it's something that if you can afford some volatility, it's worthwhile, that additional return. Yeah, Reg 28, blessing or curse? You know, it's again a very good question. You know, there's two ways of looking at it. As an investor, it would be nice to have more money offshore, because you can diversify your growth and you can have your currency protection. As a person living in South Africa, well, it's also nice to have people encouraged to invest locally, so that people are building hospitals and building roads and building railways, and making sure that, you know, when you do retire, not only do you have a pension fund, but you have something to spend the pension on. I know it's a bit of a bleak look, but you do need to balance both. Assuming we don't move into Venezuela or a Zimbabwe type environment, and assuming we get back to the new normal, obviously right now with things incredibly strict as there have been, and a completely black swan event that we're going through for COVID-19, yes, we would have benefited from having more offshore. But in a normalized environment, you know, if we can get growth back on track, then 30% is actually more than enough. You know, if you look back over the last 30 years at what the rand's done, despite weakening every year by 5% or 6%, you actually don't need more than 30%. So assuming that, you know, structurally we can get things right, then Reg 28 is more of a blessing than a curse. Yep, PEs are very high. I have mentioned that. Mostly in the lockdown winners. Lockdown losers, PEs have remained very low. So it's, again, there's huge amounts of liquidity being pumped into the system as a result of quantitative easing and all the fiscal support. People have to put money somewhere. Globally, they can't put it in cash. Globally, they can't put it in bonds. They could buy South African bonds and it's hedged. Otherwise, they've got to put it into equities. You can put it into cheap lockdown losers, or which earn a decent dividend yield, or you can put it into very expensive lockdown winners like tech stocks and to a lesser extent the healthcare stocks. And certainly it seems that most people would prefer to hide their cash in lockdown winners. If at some point we see a rotation when vaccines come out, or who knows what the catalyst is going to be, we expect the PEs of tech stocks, lockdown winners, to come down, and the PEs of lockdown losers, emerging markets and bank stocks to normalize a bit. Another good question. It's quite a tough question from asking, you know, if you've been sitting in South African stocks and you've incurred basically financial stocks, South Africa, JSE, bank stocks have halved this year. Tech stocks have doubled. If you're sitting in those stocks, do sell them now and start to buy tech. Very, very difficult question to answer. You know, as I've mentioned, we're fortunately in a position where we've had the tech. We are in a position where we slowly are selling, locking in the profits, where they've doubled, and increasing allocation to the things that have halved. We can't see a catalyst yet, but you know, when things swing, they will swing very quickly. And you know, you might want to take tranches and do small amounts, but to lock in that full position right now, I think is quite extreme when positioning is looking as extreme as it is. A question about Skeleton 40. Someone wanting to move their problem fund. Unfortunately, I don't understand what they're currently invested in, but certainly the Skeleton 40 has more bonds and less equities than Skeleton 70. So if you do want to reduce the risk in your portfolios, that is something that is worth doing. yeah, we do believe that tech and NASDAQ are due for a correction. We saw a 10% correction over the last 2 days. A lot of people are saying buy this dip. I don't think we're through the worst, but it's impossible to say. So again, we can't time markets. We do things incrementally. As they reach new highs, we take off small positions and increase our underweight position in that. Sygnia All Bond versus Sygnia Enhanced Bond. Please dial in for the webinar on the 14th of September. Again, it depends on your risk appetite. You're getting an extra roughly 0.5% from the Enhanced All Bond, which is invested in not South African government bonds, but SOEs or banks. All the SOEs are government guaranteed. So you're taking on a bit of credit risk, a very high quality credit for an additional return. So if you like, you can take on a bit more risk for a bit more return, and that's up to you. And what about the Sygnia Income Fund rather than bonds? So the Sygnia Income Fund is a great fund, but you need to look at it relative to cash. So the Sygnia Income Fund is giving you about 2%, maybe 2.5% above cash. So if you don't want the volatility or the duration risk afforded to you by bonds, but you're worried that cash is only giving you 3.5%, well, then you can move out of cash at 3.5%, and you can put it into a Sygnia Income Fund, which is giving you roughly 6.5%. So that's a good way to take on credit risk without taking on bond or duration risk. So as you move up that risk spectrum, so you've got cash, 3.5%, 4%. Then you've got income, which is credit risk, which is giving you 6.5%. Then you've got bonds, government bonds, which is giving you 9.5%. And then you've got bonds plus credit, which is giving you 10.5%. So depending on how much volatility you can take on, how much risk you can take, you can move up that spectrum. All pretty low risk overall compared to equities, and the volatility a lot lower than equity volatility. Yeah, so you can choose between those four funds. We will be talking about that again on our fund panel on the 14th of September, so please dial in for that. And that's the end of the questions. I see we're out of time. Thank you very much for dialing in. Enjoy your September, and we look forward to spring starting soon. Have a good weekend.